Hello and welcome. Today we shall be taking a look at one of the United Kingdom's oldest merchant banks, Brothers PLC. The company has a market capital of £2.2 billion and is currently ranked 60th in the UK FTSE 250 index. In the 2018 financial year to July, it had a turnover of £805 million and an operating profit before tax of £271 million, which gave it a margin of 33.6%. It currently pays an annual dividend yield of 4.3%, which is paid semi-annually in April and November. The dividend is covered 2.2 times by the earnings per share. The Close family had been in banking for almost 100 years when in 1878 the 25-year-old William Brooke Close and brothers Fred and James founded the Iowa Land Company, initially purchasing land and enticing sons of British upper classes to pursue the life of farming the northwest Iowa Prairie. The brothers provided farm mortgages to tenants for the land, the money from which was used to finance the first railroad from Canada to Alaska. Close Brothers was listed on the London Stock Exchange in 1984. The current CEO, Preben Prebenson, was appointed in April 2009 from Catlin Insurance, where he was Chief Investment Officer. Prior to that, Mr. Prebenson spent 20 years at JP Morgan in a number of roles in London and New York. He is also a non-executive director at British Land Company PLC since 2017. Close Brothers operates principally in the UK with over 50 offices employing 3,300 people. It is a leading UK merchant banking group providing lending, securities trading, wealth management services. Over 93% of the 2017 revenue was from the UK and the remainder from the Channel Islands, Germany, Ireland and Poland. The group is divided into three divisions: banking, securities and asset management. The banking division for small and medium-sized businesses and individuals is the largest with 83% of profit and consists of 27% for retail, commercial 25% and property 31%. Retail banking consists of providing finance for acquisition of new and used vehicles and insurance for over 2 million companies and individuals via a network of 1,700 insurance brokers. Commercial consists of asset finance, which provides commercial asset financing, hire purchase and lease solutions. Invoice finance works with 2,300 small businesses, providing debt factoring, invoice discounting and asset-based lending. The property business specialises in short-term residential development finance. The second division, securities, comprises of Winterflood, a leading UK market maker for retail stockbrokers and institutions. The final division, asset management, provides financial advice and investment management services to private clients in the UK, with over £10 billion assets under management. For the previous 5 years, Close Brothers has had a consistent revenue of between £628 and £805 million, and an operating profit margin ranging from 30.1% to 34.5%. This gives it an overall average of 32.9%. The forecast for next year is a 2.6% increase in revenue to around £826 million, with a profit margin of 33%. With generated earnings for the previous 5 years of between 101 pence and 140.2 pence per share, the dividend has always been well covered by over twice the earnings per share. The earnings per share is forecast to decline 2% in 2019, but the dividend will still be well covered at 2.1 times and continue to be increased, this time forecast to be 3%. The share price standard deviation for the previous 12 months was 62, compared to 886 for the FTSE 250. The current share price is 26.7% above the 52-week intraday low. With the current net asset value at 891 pence, the share price ratio is at 1.65, which is low to the 3-year historical average multiple of 2. On the 14th of September 2018, Close Brothers announced the sale of Close Brothers Retail Finance, which provided unsecured finance to consumers through retailers. This sale reflected the group's decision to exit the unsecured retail point-of-sale finance market, as the business did not provide a long-term fit with their predominantly secured business model. On the 15th of November, trading update stated that the banking division loan book value had increased 1.9% in the quarter to £7.4 billion. Winterflood remained resilient in the first quarter against a backdrop of more challenging market conditions, but asset management reported negative market movements resulted in a slight decline in management assets to £10.2 billion. In the market update on the 22nd of January 2019, the banking division had continued to perform well, with the loan book growing 3.1% in the period to £7.5 billion. Winterflood had continued to deliver solid profitability, but volumes and trading income had been significantly lower than the prior year, reflecting difficulty and volatile equity market conditions. Asset management had continued to achieve good net inflows, although these were more than offset by negative market movements, resulting in a further decline of 3% in managed assets, which now stood at £10 billion. Close Brothers has a prudent approach to lending. It has prioritised its credit quality, noticeably due to the increased pressure in the motor finance markets. By becoming more selective, it has been able to maintain its profit margin and also its attractive dividend. This dividend has never been cut since the company floated on the London Stock Exchange in 1984, and since the passing of the global financial crisis has had 8 consecutive dividend increases. Over 30% of revenue was from lending to property developments of new build family housing, as 70% of this was from London and the south east regions of England. The forecast is for some slowdown. With the disposal of the retail point of sale business and increased operational investment, Close Brothers has demonstrated its ability to adapt to changing markets. Close Brothers continues to demonstrate its ability, when compared to its peers, to operate with a low tangible asset to equity ratio of 8.8. This is one of the lowest amongst the mainstream and alternative lenders. The share price to net asset value is also at a 3-year historical low. It has a price earnings ratio of 10.5 compared to the FTSE 250 of 16.3 and a dividend yield of 4.3 when compared to the FTSE 250 average of 3.17. This dividend is covered 2.2 times by earnings. Close Brothers is a well-managed company with a solid track record of maintaining the progressive dividend. For these reasons, I've given it a rating of 4.8 out of 5. Thank you for watching. Please leave comments below. And also like and subscribe for further analysis of UK company businesses.